Dive into the chilling world of real-life home buying horror stories. From deals gone disastrously wrong to shocking scams and unexpected twists, Mortgage Nightmares reveals the dark side of real estate through the experiences of those who lived it. Join us each episode as we uncover the terrifying truths behind buying a home and provide insights to help you avoid a nightmare of your own.
So we are on episode
Four.
already.
Four.
Wow, okay. All right. Time flies by. And boy, have we had some really good stories. If you haven't listened to the ones before, I highly suggest going back. There is everything from people losing their life savings and getting scammed to escrow officers going to jail
Prison time,
mid-transaction,
for
jail
millions.
time, $10 million paid in restitutions.
FBI knocking on your door.
Yeah, to a transaction where it seems like everything is going perfectly fine, only to find out that it's not.
Mm-hmm.
Well, today's story is kind of a sad one. You know, it does not have a good ending.
Not the happy ending.
Unfortunately.
We don't have our white knight coming in on the horse to save the deal.
Right.
On this one.
Right. There is no saving this deal, unfortunately, which we will get to that. First, I want to say thank you to our sponsor, Military Home Loans, for allowing us to use their studio, letting us borrow their branch manager. I am your host, Ricky Nava. I am a mortgage loan originator. Been in the business for going on 9 years. So again, a lot of these stories I have experienced, you have experienced. Some are from users, some are that we've heard from other people in the industry.
Mm-hmm.
I'm also here with my co-host, Clay Murray.
Absolutely. Thank you. Episode 4. Super excited. Again, yes, Clay Murray, branch manager of Military Home Loans. Putting a bow on my 10th year in the industry and excited to start year number 11. And you're right, man. I mean, a lot of these things we've talked about are our experiences, right?
Yeah.
We've got many loans under our belts. And behind every loan that closes, there's probably tens of clients that we talk to who never get to that point. So, man, I would think I've talked to thousands of people about mortgages in my career. And yet, there are still stories that come through that are juicy enough and salacious enough that we borrow them.
Right.
And that's today's story, right? Today's story comes from a mutual friend in the industry and a client of his and an experience that he had, or at least a story that he shared with us. So This one's going to be fun.
Yeah, definitely. And again, the whole purpose, of this show is not just to sit here and gossip about other people and things that have happened, right? I mean, the whole point of the show is to really show you what can happen.
Yeah.
And help you avoid it, because a lot of these things are avoidable. Today's is
absolutely
100% avoidable.
I thought you were going to say today's is not avoidable.
No, today's
absolutely
is 100% avoidable. So this is going to be a good lesson for everyone involved.
Yeah, and so another part of this is, our shared experiences, like we talked about. Mm-hmm. This one comes from a buddy in the industry, but we want to hear your stories.
Yeah.
Right. So if you have a story, send us a DM, send us an email, find us online, find us on our socials, get us your story, or reach out or have us reach out to you and give us the juicy details. Because your nightmares, we want them to be our nightmares so that we can make them everybody's nightmares. Yeah. But in reality, you're right. We want to try and help people avoid nightmares like this. So telling a good story about what happened, how it happened, and potentially how it can be avoided is what we're all about.
Right. Absolutely. So, you ready to get started?
I'm ready, man. Absolutely.
All right.
So I'll take the driver's seat on this one and just kind of roll through exactly how it went down.
Set the scene for us.
Okay. So this one, as we said, comes from a buddy, right? Another loan officer in the industry. And this was his client, as I recall. I guess I can't say that with complete certainty, but it was either a client of his or somebody on his team, right? You and I, we work in the same office.
I know the story, so I'm pretty sure it was his client.
Yeah. Okay. So let's go with that. Let's assume it is. If it's not, I don't care. It's going to be a great story regardless.
Right.
But let's say, yes, it's his client. So this is a past client of his. He helped him purchase the house years and years and years ago. And like us, referrals are great. That's what we kind of live off of, is when we do a good job for our clients, they send somebody back to us and say,
Right.
hey, you got to work with Ricky, you got to work with Clay. But also we expect them to come back to us when they need more mortgage service or advice or whatever it is.
Yep.
I tell my clients, your clients for life. I'm your mortgage advisor for life. So whatever you need, come to me. I've got answers for you. So he comes back to our buddy and he asks him for help with a refinance. And for those of you who don't know, why don't you kind of outline a refinance? What are the options for a refinance? Why would somebody do it?
So once you already own a home, there are several reasons why somebody might want to refinance. One, I would say probably the primary reason would be to lower the interest rate. That is one way to refinance. If you can drop the rate, you can drop your payment, especially in the market that we're in now. I would say the majority of people who are buying right now will have the opportunity to be able to refinance and lower their interest rate.
They can't wait to do so.
Right.
Yeah, because rates have been high for like the last 2 to 3 years.
They have.
Yeah.
They have. And they should be going back down.
Right.
So at that point, you would refinance, which a refinance is basically you just getting a new mortgage. You pay off your current one, you get a new one with whatever new terms that you're looking for, whether it's a lower interest rate or cash out.
Yes.
If you gain enough equity in your property to the point where you are able to take some of that equity out, you can do what's called a cash out refinance. And in a cash out refinance, you can pull money out of your equity for things like home improvement, right? What if you want to remodel your house?
Yeah.
It's a great way to pull cash out.
I don't have the money to do it myself.
Or
my house is worth some money.
debt consolidation.
Yeah.
You want to pay off some
Big
debt?
one.
That is a huge one as well. Yeah. I mean, really, lots of different reasons why. But the whole point is that if there's equity in your home, you can pull it out by refinancing. And which, in this particular situation, it was a cash out refinance, right?
That was this guy's goal. And it's interesting because the equity in our home is just theoretical, right? The equity is a product of what is your home worth and how much do you owe on it? And the difference between the two is how much equity you have. But it's kind of like, it's not exactly fictitious because the market does kind of dictate what your home is worth. You certainly have an unpaid principal balance on your loan. So those two things are real monikers, but the difference between is just like invisible money. And it's not realized until you actually reach in there and pull it out via cash out refinance or home equity line of credit, etc.
Right. Now, your home value does fluctuate.
Yes.
Which is why there are guidelines in place to protect you from being upside down on your mortgage, because you don't want to take out every single penny that might be available today. If the market takes a downturn, your value goes down, now you owe more than what the house is worth.
Yep.
So there are rules in place saying that you have to usually maintain at least 20% equity in your home. And apart from that, whatever else is there, you can take out. But there always has to be a cushion.
Yeah, that buffer zone.
Little buffer zone.
Bingo. Yeah, last week we talked about guidelines a lot.
Right.
That is one of those guidelines is, hey, if you're going to pull cash out, you can't pull all of it out.
Right.
Because you're right. If you happen to slide in that home value, you don't want to be underwater. So, safe to say, this guy who owned his home for years and years had lots of equity. And that's a byproduct of paying your loan balance down while also seeing your value appreciate. You're creating separation between your loan to value ratio. So he had lots of money to tie into and grab, so much so that, and he was an older guy, right? He had owned this home for years and years. His plan was, I'm going to pull this money out and I'm going to be set. I'm going to be set. I'm either going to invest it in other things that are going to give me recurring income, or I'm just going to sit back and live on my assets. I don't need a job anymore. My lifestyle isn't that expensive. This new mortgage that our buddy is hooking him up with isn't expensive. In his eyes, he can afford the payments.
Right.
And I'm going to have hundreds of thousands of dollars of equity to just sit back, kick it, and live on my assets. So for somebody in his position in life, somewhat expected, right? You want to live on your assets at some point. You no longer want to work. He was at that juncture and he was ready to do it.
Okay.
So that's kind of setting the scene, right? As you said, let's set the scene. So
he has a bunch of equity.
Yep.
He wants to pull it out. and just have this big chunk of money that he can live off of until he figures out either what he wants to do next or just maybe it's enough to live out the rest of his days.
Correct. And
Seems like a pretty good plan.
it is. And the plan is great because in his eyes, like, and I don't know the sum of money. Maybe it was $1 million, which years ago was a ton of money, right? And maybe $1 million, he was like, I don't have to have recurring income anymore. I can live on $1 million comfortably for decades. But in the eyes of approving the loan, you have to have what they call ATR, ability to repay. Even if your home loan is $500,000 and you have $2 million of assets, you could pay for it all if you wanted to. You still need to show on a conventional loan that you have recurring income where you can use that income to make your mortgage payment. You cannot show, hey, I'm going to live on my assets. There are some ways to do it now, but when this guy was doing it, they didn't have asset liquidation or anything like that where you could do depletion of your assets and create fictitious income. So,
but in layman's term, you basically need to have a job.
Yes, sorry, you're right.
You need to have a job.
Yeah, you got to have a job, Johnny. You can't just not have a job and expect us to give you a loan where there's regular monthly payments.
Right, yeah.
You need to show ability to
some sort of
repay.
income.
Yes. So our buddy advised him like, hey man, I love your plan. You got plenty of equity here. If this fits into your life goal and you can live on it, great. But until you're actually funded, we get you the money, don't quit your job. Don't quit your job. There are a few golden rules in mortgages. And we talk about this with clients all the time, is when you're shopping for your mortgage, whether it's you're purchasing a home or you're doing a refi, like don't make any major life changes. Don't go buy that car. Don't go quit your job. Don't change jobs. Don't loan your brother money. Don't sign on as a co-borrower with somebody else or something like that. Don't make major financial changes.
I think another big one too is when people are in the middle of buying a home, they might finance all of their appliances onto a credit card.
Yeah.
And at the very end, you know, when there's a last check to see if you acquired any new debt,
They're
if
like,
all
wow.
of those appliances push you over your debt to income ratio,
Right.
now there's a problem. You might not be able to close on your home.
Exactly.
So,
And that's what I'm talking about. You no longer have the ability to repay. You can no longer show the ability to repay.
well,
At least at an acceptable debt to income ratio, which is
Right.
what we deal with.
I feel like we kind of breezed over that, but can we go through one by one just so everybody knows the things that you should not do when you're in the middle of a mortgage?
Yeah.
The first one obviously is don't quit your job.
Yeah. You know what? You're right. Because these are all like, these could be nightmares.
Right,
If you do
yeah.
any or all of these.
Each on their own.
Yeah. Don't quit your job.
Right.
And in fact, ideally, don't change jobs. Whether it's within the same employer or you take new employment, don't change your job. And you're right, don't acquire any new major debt. I said don't go buy that car, right?
Yeah.
Usually
But
that
that's a
means
good
financing.
example of acquiring debt because it's not just buying a car. It's not just putting something on your credit card.
Yeah.
It's also co-signing for somebody else.
Yeah. Oh, it's not my debt. I just listed myself as a co-signer for mom.
Well, guess what? That's your debt.
That's
now.
your debt now, brother. So
Yeah.
yeah, we got to watch out for that. Don't have any major influx or outflux. That's not a word, is it? Don't have any major fluctuations in your assets, right? Don't have any
Right.
large deposits or large expenses, money flowing in and
Don't
out.
make huge cash deposits in the middle of your transaction.
Yeah, cash scares underwriters. Like, oh my God, where'd that
Yeah.
money come from? Who do you owe now? Do we have to include a payment? So
Try not to move your money around into too many different
Yeah.
accounts. I mean, obviously, if you have your money in 3 accounts and you want to consolidate into one account to make it easier at the end to wire your money, great.
Yep.
But if you're going to be moving stuff around between accounts, consult your loan officer first and
Yes.
make sure that everything is going to be okay, kosher, and not cause any sort of problem.
Absolutely. Because when your money moves around, now we have to document all of that moving. So
Right.
while it may be okay to do, you're just creating more work and documentation requirements for yourself.
And actually, I have another mortgage nightmare that has to do with moving money around.
Oh,
But we're
no.
going to save that for a different day.
Holster that bad boy.
Yeah.
Okay. So, yes, don't quit your job. No major purchases. Don't move money around. Don't co-sign for somebody. These are all like golden rule of mortgage things that you're not supposed to do. Okay? Just maintain the course that you were pre-approved with and or underwritten with, and don't make any changes until you've either got keys in hand on your purchase or you've got cash in your account from a cash out refinance.
Right.
Right? Okay. All right. So let me kind of walk through this guy's loan process because we've talked about purchases before. This refinance, a little bit different.
Right.
Remarkably similar.
But it is our first time
talking about a
refinance.
Yeah,
right.
you're right.
Okay.
So again, he already owns the home. So at the end of the day, he's going to continue to own his home. Unlike if you botch a purchase, you may not get to buy the house.
Right.
Right? So anyway, he goes through the pre-approval process, right? We need to make sure you're still approved because you're pulling cash out. Your payment's going to be a little bit higher because you're mortgaging more money.
So
All
you
right.
still have to be pre-approved even for a refinance.
Don't have to be, but you should be. Absolutely. Before you start making any decisions of what the rest of your life's going to look like. Yeah.
Right.
So he gets pre-approved by our buddy, and then they start the application. They lock his loan. Rates were good. They wanted to take advantage of it. They ordered the appraisal. Hey, we need to make sure we know what your home is worth. Came back at an acceptable value. The file was underwritten. Remember, we talked about that being the gatekeeper to the mortgages, the underwriter.
Right.
Underwriter says, absolutely, you're approved with conditions. Like we said, happens about 99% of the time.
Mm-hmm.
Here's your short list of conditions. Boom, boom, boom. Hammered them all out. No big deal. All right. Then he gets to the point in the process, which is first step, underwriter reviews, approves with conditions. Second step, I'm going to send you back all of my satisfied conditions that you requested. And you're going
mainly, documents like updated pay stubs,
Yeah.
updated bank statements, things like that.
maybe his insurance was coming due again. That happens every year. Send
Copy
us
of your insurance
copy
policy.
of your insurance policy.
Right.
Absolutely. Or connect us with your agent so we can renew.
Yeah.
Appraisal, certainly one of them. Rate lock, one of them. So he had done all those things.
Yeah.
Send them back to the underwriter for conditional review
Mm-hmm.
as we head toward final approval. And it's funny. There's videos and memes that go around in our mortgage and real estate circle on social media where you see oh my gosh, that moment you hear the clear to close and your hands go in the air or you
Yeah.
sip your drink or whatever. But clear to close is oh my gosh, we have full loan approval. The underwriter's totally good with us. There's no more conditions for us to satisfy. Here we go. Let's do final disclosures. Let's generate loan documents. These are the legal documents that go toward recording your mortgage note, recording your transaction with public record, sit you down with a notary. It's a full thing.
Yeah, and once you get the clear to close, your loan's closing.
Yeah.
Right?
You're doing the happy dance.
Yeah, unless something crazy happens,
Exactly.
your loan is going to close.
Correct. Now, with some mortgages and most mortgage companies, you do the clear to close, you sit down and you sign your docs with the notary, and then those documents come back to the mortgage company for a final review before what's called funding.
Mm-hmm.
Funding is, all right, we're going to send the money for your new loan to be consummated, which most of it will go toward paying off your current loan. And then in this guy's case, a large, handsome sum of money will also go to you, the homeowner, for your cash out. Okay, so that is funding. As a last step of the procedure, right, before we do everything and send all the money out, it is extremely common for the mortgage company to do a final verification. And in particular, this was a final verification of employment.
Right, because they want to make sure that you're still employed.
Yeah, and
Even till the very end.
It has to do with what we talked about. You still have the ability to repay. So up front, we do a written verification of employment. It's a document that's filled out with how much money you make, how long you've been on the job, what your position is, are you expected to get any raises, bonuses, these kinds of things.
And the employer fills that out.
Yes, the employer fills it out, sends it back to the mortgage company.
Mm-hmm.
But at funding, we already did the whole written one.
Right.
We're just going to call and do a verbal verification hey, is Johnny still employed?
Just to make sure he didn't get fired or something, right? Something crazy.
Or, did Johnny die? Or, did Johnny's wife have a baby and now he's on leave? Did anything change about his employment?
And I think it's important to realize that it's not just us doing that to be bad guys and try and catch somebody in a lie. It's mainly for protection of the bank. The banks are the ones issuing this money, and they go off a risk.
Yep.
And they're trying to do everything possible to minimize their risk.
Totally.
Because think about it. You're letting somebody borrow hundreds of thousands of dollars. So anything you can do to minimize the risk of somebody going into default and not being able to pay back that mortgage.
Yes,
These are all that's why they put these guidelines in place.
totally. Well, and it's also to protect the consumer. Like, what if you just lost your job and I just hit the button to give you an $800,000 loan and you got to pay me $8,000 a month and you lost your job? You might be like, oh, shoot, I can't afford this mortgage.
Yeah, you can't unhit the button.
Right. So there is a layer of protection for the consumer as well.
Right.
Which, I hadn't really thought about, but that's totally in place as well. It all goes back to ability to repay, whether that's for me to feel good about it as the bank, for you to feel good about it as a consumer.
Yep. Everybody
Everybody should feel good about your ability to repay. So anyway, during the process, we all have CRMs, right? Client relationship managers. It's our database of clients that help us keep in touch with our clients. Names, contact information, like a task list of who we should follow up with when. And this particular one says, hey, you're in process, you're getting a loan from us. There's cool milestones along the way, like you're underwritten, your appraisal came back, and you're clear to close.
Things to celebrate,
Absolutely.
Yeah.
And when you're clear to close,
Shot of dopamine.
that's that final approval.
Yeah.
And it's not uncommon for like an automated video to go out to like be really congratulatory.
Yeah.
So this guy got this video or this email or whatever that says, hey, you're clear to close. Like there's no more conditions for your approval. You're about to get your money. We're going to send out your documents, whatever.
Put that champagne on ice.
Absolutely.
Because we are close to getting ready to pop it.
But don't pop it yet.
Don't
bro.
pop it yet.
All right. This guy he just intercepted the ball on his own 5. He's sprinting all the way down the other side of the field. He is at the goal line of the other team about to score, and he thinks he's scored already. We've all seen the guy who drops the ball before the goal line. He's about to do that.
So you're saying that he got the clear to close.
Got the clear to close.
He's
and
like,
thought,
yes.
Done deal.
Final loan approved. Everything's done. There's no takesies, backsies.
Right. And if you'll recall, he's going to live on all this money he's about
Right.
to get, so he no longer needs a job. So what's he do? He goes to his job and says, in spectacular fashion, I don't need this job anymore. F you guys. I'm out of here. Birds in the air, flips off his boss, like just blows the joint. Like probably all of us have fantasized about doing.
Oh,
This
no.
guy does it. And he's gone, right? Spectacularly. God, I wish I could have seen it.
Oh, jeez.
So then on funding day, they call to do the verbal verification of employment.
Hurts.
Hey, does Johnny still work there? And he's like, what? Johnny, no. Johnny quit 2 days ago.
Oh my God.
Flipped this all off, said how he doesn't need this job anymore. He's going to live on all this money. Screw you guys. I'm out of here. No, he doesn't live here anymore or work here anymore.
Jeez.
And that was it. That was enough to not score the touchdown. That was a fumble on the 1 yard line. That was enough to kill the deal. No cash for Johnny.
Obviously, they're not going to fund a loan where you're not working anymore. That's literally the whole point of that verification.
The crux of the approval was
employment
his income.
Jeez.
Yep. So, deal dead right there.
There's nothing
On
else you
the
can do.
goal line.
Nothing
No.
else you can do.
Nothing you
Can't get his job back. It's too late.
No, not flipping off your boss.
That's too late.
Hey, can you imagine coming back hat in hand like, I'm
hey,
sorry.
Can I have my
we're
job
cool.
back for 3 more days?
Yeah,
please?
exactly.
And then
or,
I'll quit.
I got you. Just kidding.
Jeez.
No, it was a deal killer.
That is terrible.
Moral of this one, do not make any major changes in your application or your approval criteria, whatever that is, income, assets, debts, doesn't matter, until you have keys in hand or money in your account and the deal is done.
Yes, the deal is not done when you get the congratulations, you are clear to close, or congratulations, you have final loan approval.
Right.
It's not until you get the congratulations, your loan has funded
And recorded.
and recorded.
Yes.
Yes. Like
And you're done.
escrow is closed.
Absolutely.
That's after that, whatever you do is none of our business.
True.
Although we do recommend not quitting your job because now you have a mortgage to
Right.
pay
You
back,
still
right?
need to show the ability to repay.
But whatever you do after that is none of our business.
Right.
Geez, that is just terrible. I feel bad. And you know what this makes me think of?
Do you?
It makes
What?
me think we should, like, I don't even think this is possible, but wouldn't it be nice to do like a Where Are They Now? like type of thing. Like, where are they?
I don't know, man. We talked
Where
to somebody
are
who went to
they?
prison and had to pay $10 million, but
And we actually did talk about after the show. We're like, I wonder what they're doing now. You know?
yeah, it would be great to
Those
find out
people
what
who
they're
went to
doing
jail,
now,
yeah.
but maybe not like have them on to tell us about it.
You never know. I mean,
Although
hey,
that would be great.
what in that?
Coming soon.
I know. Jeez.
Mortgage
Hey, well, if
nightmares
you're
reprised.
if you're listening to this and this was you that it happened to, which we don't know who you are, call us. Let us
Yeah.
know. Let
Yeah.
us know.
We want to hear from you.
Hopefully, everything turned out all right.
Yeah.
We do want to say that it is important to note that it's not like he lost his house,
Right.
Because you still have the house.
Still has the house.
You own the house.
Still has the equity.
Yeah, and he can
Just-
go out and get another job if he wants to, and
Right.
maybe try again down the road in the future, right?
Yep.
But it was just a very unfortunate thing to happen at that particular time.
Absolutely.
And we know the loan officer that was involved in this, so I'm pretty confident in saying that he probably did warn him not to do these things. He
Yeah.
probably went through the list of don't do
Absolutely.
these things.
Guy's very thorough.
Yeah, so it was just probably completely on him.
Yeah, I mean,
Right.
the guy saw the congratulations and just celebrated too early.
Yep.
And just celebrated like top notch.
Yeah.
You gotta love that.
Yeah.
So we tell these stories, and again, the purpose is not to twist the knife or really rub it in this guy's face, but again, to advise you about particular mortgage nightmares that can come about. That is our goal of this show, is we want to help people avoid nightmares of their own.
Absolutely. Well, thank you so much for sharing that story today, Clay. That is it for our episode. Stay tuned for next week, which, again, I don't want to tease it too much, but it's going to be a good one.
Yeah, always is.
Yeah, it always is.
Yeah.
Well, thank you, everybody, for tuning in, and hopefully we can help you avoid a mortgage nightmare of your own.
Bye-bye.